Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic, trading the trend. I am your host, Kevin Horner, in for our buddy James Boyd today, who is on some personal time away. So thanks for being here, everybody. Of course, this will go differently than it usually does with JB, as we're going to lean in to what's going on in the market today, in the moment, which has been very interesting since I hosted Trader Talk just a few hours ago. But that's actually quite helpful under the circumstances, because now we can start talking about the important levels, right? We've learned some important information about the market today so far. For those of you who are short-term traders, perhaps we're learning something for those of you who are a bit more long-term as well. We'll look at some levels as it relates to the S&P 500, the NASDAQ 100, and the Russell 2000. And we're going to talk about as well understanding trends and utilizing those trend understandings over multiple time frames. That's really a key component to being a trader, is knowing that time frame matters, especially to us individually. So with that kicking us off, I'll remind you we're joined by our friend Rachel Dashell here in the chat. You can follow Rachel on X at Rachel-CS. You can also follow me there, of course, at Kevin Horner CS. It's the best way for you to meet up with us coaches when we're not hosting classes for you. So join us there on X. Also, don't forget to be subscribed to the channel. And if today, as we go through the discussion of trend analysis and so forth, it's helpful for you, it would be helpful to us if you hit that thumbs up button down below so that we can get this into the archive and available to even more viewers. All right, so with that, let us review some disclosures quickly, and then we'll look at the charts. So first of all, remember that everything we do for you on the channel here is informational and educational. We do not make recommendations. We do not make endorsements for any approach to trading the market here. We will discuss technical analysis, and as this class discusses trends, trends are part of technical analysis, and understanding the current trends is really the job of us as traders as we go down the road here. It's so important for us to have a good understanding of maybe the most important trend. For a lot of the time, that's going to be a long-term viewpoint. But essentially, when we talk technical analysis, just remember that we're talking about concepts and strategies traders might choose to employ. Beyond that, there are alternatives, there are options for you to consider, but by no means the only way to go about things. We also think that you should incorporate a multitude of concepts and ideas and pieces of information when you are making your decision. So with that, let's get to what we've got going on in the S&P 500, which will be our kickoff here. So, what are we going to say? I mean, we opened strongly. We got through the 50-day moving average. We tested with our intraday high today, the 20-day. Let me take a quick look. The 20-day moving average coming in at 67.75 at the moment, and our intraday high 67.70. So we missed it by about 5 points. Once we got that open, and we talked about this in Trader Talk, of course, we talked about the want to maintain the gap ledge, and we didn't even come close to maintaining the gap ledge, did we, everybody? On these 15-minute bars, the sell was pretty darn speedy, and we gave back pretty much not just everything, but everything and then some. We saw a very quick 3% pullback here in the S&P 500. That was very speedy. And my hope is that for those of you who were short-term, you took the Trader Talk conversation to heart, and maybe you took some action with our move through or into that gap. If you're a frequent attendee, you know that we talk about the importance of gap levels, can be providing us with important areas of support or resistance. And ultimately, we started filling into the gap, got to the R2, as a support, because we gapped above it. We would consider that to be supportive in nature, and it just didn't hold. So on maybe a 5-minute bar, boy, it's paused for all of one 5-minute bar there, and then it was just a continued bit of selling. My goodness, there's just been no respite outside of what's going on in the last 15 minutes now as we try and come off of this new short run bottom here. So as I stated at the kickoff, the hard thing, I believe, for traders is really defining their time frame for their specific trade. A lot of us have this belief that by moving out of bad trades, admitting defeat, and covering risk, that we're taking. There's this makeup, this component of our brains that really does work to sabotage us as humans. It's not a thing that's tied to any of you individually. If you're feeling that way, it's not the case. I have been in those shoes as well. It's not fun. Let me just be honest about it. But if you're a trader by nature, then you need to be disciplined in your process, and you must be willing to exit trades that are working against you and recognize that doing so is the process by which we mitigate risk, right? And if we're properly entering our trades, if we're in proper position sizes and moving out of those trades when weakness presents itself, or following through with a trading plan, I'd say that's the most important thing for us traders to think about. So we start small trend here today because of the significance of the move. Let's back this back out to the daily chart and talk about how that candle looks right now. It's not pretty, as we know. We have that apparent test of the 20-day moving average and a throwback to the exact same level of support. So basically, the low today to this point is equal to the low we made on Wednesday, and that stands out. In the extended window here, maybe the last 6-7 weeks, we look at the green line, 65.50 on the SPX, an area for another possible test. Again, we're trying not to get too granular or fine in our analysis, because this action right here doesn't mean the low of the day today could be sufficient for a test of the support, right? But we're going to have to wait and see. And I hope that that's a big takeaway that many of you have today. And that is that intraday price action is not the same as closing market price action, right? And, for those of you who did make it to the Trader Talk session this morning, we looked at the weekly chart and we talked about how cool and how awesome that candle looked at about, 10 a.m. Eastern, 10:15 Eastern. It looked beautiful. It was green. It was all the way up, and it was a hammer candle, and it looked fantastic. It doesn't look the same, right? And that's because, we've had a reversal intraday. So if you are that trend trader in the longer term, and this is, by the way, a 5-year, not a 1-year daily, so I'm going to edit this so that I at least am valid and accurate here for you, everybody. So 5-year weekly. So what are we looking at here? Well, the trend that we're watching now is this green 20-week moving average, because that is paramount to our current trend, right? Okay, so if we can hold that level, and that level 65.47, remember the level I provided on the daily chart, 65.50. We're basically, the green line is, we're looking at the same thing. Everything is being developed at the same level. So how important is the stability of our current trend at the 65.50 level? Very important. Okay, now let's talk further about the trend potential shift. If we break the moving average, where would we start targeting? What are we going to start looking at? Well, going back to some basic trend and technical analysis levels, technical analysis 101 stuff, we might go back to when we made that push from October of 23 to our peak in early 25. And that was right about here, right around 6,100 or so. So I'll go ahead and carry that line and give us another target zone. Now, do we want to get there? No, I hope we don't get there. But we have to be prepared for that potential move. It is currently less likely that we get there, right? The first time that we're going to see the increase to the likelihood of making it to the 6,100 level is on a weekly close below that green line, giving us a new short-term, albeit lower low. Remember, we are in a series of higher highs and higher lows. That's what this trend is, right? That's an uptrend, higher highs, higher lows. Now we have matching lows in a relative window. If we start making lower lows, then our expectation becomes the continuation of this new potential short-term downtrend. Okay, we don't yet have it, but we need to be at least aware that we could. Okay, now I saw something here in the chat, and I want to address it quickly because I've been in these shoes previously. Looks like Debbie had a position that were long puts heading into this morning. You know, some protection, I would imagine, and waiting on NVIDIA to report. The morning starts hot. Everything is rallying, and the puts got sold when the market was up. And I can understand that makes some sense. But I'll tell you, one of the things that you might lean toward a little more here, Debbie, is thinking about the dollars devoted to the trade. What was the merit of closing out a put contract when the market was rallying? Did you bring back value from those puts? Or were you just simply selling them so you could get them off the screen and not look at them again? Because there's a big difference between the two. And my hope is that there was money left for you. There was value remaining in the puts, and you took that cash because you needed and wanted that cash. But if there was limited value, and you could say, you know, the value of X, and I'm totally comfortable throwing that X away, well, then just sticking with it. Let those contracts expire worthless, because instances like today, this reversal we've witnessed, this can happen. This is, I'm terribly sorry that it happened in your scenario specifically, but I've been there, and it is an excellent way to learn from that experience, because odds are strong, placed in the exact same scenario in the future, you're probably going to let those puts go. And it's just because it's a reminder of the balance of risk. You've already lost the majority of the dollars associated with NVIDIA puts at the open. At least that's what it looks like, right? And then when things shift and reverse, hey, that becomes a different opportunity. So I bring it up only because I really understand and appreciate the point, and especially for those of you making comments like this in the chat as a means of commiseration. I completely get it. I have been there, I have done it, and I've worked to learn from those mistakes as well, and I hope you do too. Don't forget, options aren't appropriate for all of us, and there's certainly a more risky scenario. So if you're interested in trading options, do your requisite homework, make sure you're approved on your needed accounts, and be familiar with the options disclosures and the risks associated with them, everyone. Okay. So back to trend analysis. One other key component we might look at here is the most recent move. It was the big sell down in April to our current high, the high we made 4 weeks ago. We can do it with a quick Fibonacci level, and all we're doing here is trying to understand areas for potential bounces. So the sell-off stopped here in early April, and then the rally stopped here 4 weeks ago. And we'll just draw that line, and we're looking for confirmation as we do this, everyone. And sure enough, we got it, don't we? Look at where we are. That green line, that ever important green line at a level of 6,100, former resistance, now potential support, coincides with a 38% pullback in the SPX off of highs. That would represent an appropriate area for not just a pullback, but also a potential bounce. Okay? Doesn't mean we get there. It doesn't mean we hold if we get there. But it becomes an area where initially sellers might lose steam. So if a trader were to see us take the SPX beneath the green 20-week moving average, well, then we could start to expect a bit more choppiness and a bit more volatility and the potential for weakness down to my white line, coincident with that same 6,100 and the 38% retracement. The white line is the 40-week moving average. Okay, so you can see historically, when we have violated the 20-week, we've also seen the 40-week give us a bounce opportunity. So it can work, but that's what we're waiting on. That's what we're thinking about. That's what we're going to be determining over the course of the coming days and weeks here. Is going to have a lot to do with the recent levels that we've established. Okay, so there is a long-term look, a longer-term look at your S&P 500 5-year chart. Now, we also have to give thought to why we look at the 5-year weekly chart. What is the important aspect of the 5-year weekly? Well, my hope is that if we can be good at understanding the longer range trend, we can use the longer range trend within the shorter term trends to help us place our trades. So what I find interesting, let's add some time to this. This is, again, like I said, 5-year weekly. Let's make it a 10. And let's talk about the S&P after a big move like we got from COVID, okay? So let's just kind of see if we can mirror some of these moves here. We went up about 120% COVID bottom to the post-COVID bottom peak in late 21. Here we rallied not remotely close to 120, I don't think, only about 40%, 43%, okay? But we also, after having moved aggressively to the upside, we then pulled back and had an entire, almost a full year plus of a drawdown here, right? So let's look in. I'm going to zoom in a little bit to this window where we had a wonderful run, 120%, and then suddenly we're below that green 20-week moving average, and boy, that 20-week became resistance rather quickly, didn't it? And you can utilize some of this in a very similar fashion, can't we? Because we broke the 20-week in green back here, creating the initial breakdown. We failed on the weekly as we got into that 20-week once more. Notice a pretty ugly candle there, right? That looks like a bit of a shooting star where we were up all week, except closed basically at the lows of the week. And then the very next week, we traded through the low of that week. This became our high week. So we traded through the low of our high week, and that became a sell signal on a longer term chart. And it was a continuation. So what did we get? The trend in this window, albeit not extremely long, right? January of 22 to the bottom in October of 22. That was the bottom, but we didn't know it was the bottom until we got through right about here. And actually, I would have started, I think a lot of traders with me here would have started to agree. Oh, I would have felt a lot better about it right there because we broke the downtrend line. But notice that the resisting downtrend line, if I carry that forward, caught the bottom of that pullback. So I'll tell you, the instances in which I say former resistance, now support, former support, now potential resistance, that comes out so frequently. And we traders, we can fall back on the basic tenets of technical analysis and trend analysis and utilize those to our benefit. So could we feel a little better here? Yes. Should we have maybe been prepared for not a continuation immediately, but perhaps some opportunity for even a deeper pullback? We should. We should be prepared. We should be thoughtful. Doesn't mean we're going to get it, but we should at least be prepared. So the thing that I enjoy about technical analysis, and I hope is starting to really take root for many of you, is that technical analysis can be applied on this weekly chart. We can take the same concepts, apply those to daily charts, take those exact same concepts and apply those to intra-period charts. And we can build our trades based on all three of those time frames: weekly, daily, hourly, if we prefer. Take your pick, okay? But I would not encourage a trader to stick to a single time frame when evaluating trend analysis. You've got to take note, of where is the broader, more important trend. And for many traders, even the short-term ones, what's happening here on the weekly chart is equally, if not more important, to what's going on your daily. Okay, the action you're in the midst of right now, for example, may very well be tied to the fact that we've made that 42% pop in the S&P 500 over 7 months. That's a very strong move to the upside in a very short-term window. Volatility to the upside is likely to be resolved with volatility to the downside. So we're just going to have to see to what extent that retreat happens. Maybe it's already happened and that's all we're going to get. That remains to be seen, but that's what we're waiting on as it relates to the S&P. Now, let's go back into that daily look at things. Okay, so I think the levels are well established for the trend here in the S&P. We've noted 6550 for the short term, and then 6100. A couple of things about it. If we get to 61, we're going to be taking out the 200 day, right, in blue. That would be a significant development. The last time we were below the 200 day, it was below it for, let's see, until here. So it took 47 bars, okay? So 45 bars would be just shy of 10 weeks, right? Just shy of it. So we were below the 200 for about 10 weeks. Now, this again might lead some of us towards a discussion on trend and how do you manage your own trades. Many of you don't even put yourselves in positions to, if your stock is under the 200 day, maybe you're defensive in nature if the S&P 500 is below the 200 day, or maybe you're the trend trader who's evaluating those levels more clearly and wants to take advantage of these dramatic moves to the downside to participate on the long side, and you're taking your shots at lows. That's a possibility as well. But all that stated, my hope is that we are learning something about the importance of these moving averages, okay? So that's where we stand on the S&P. Now, I'm going to quickly build a new chart here to aid for those of you short-term traders who might be looking to evaluate what's going on in the S&P 500. That's a great, good one there, Wild Goose. What's going on in the S&P 500 and in conjunction with what's happening with the volatility index, the VIX. What made me laugh about that goose, Wild Goose, is that it reminds me of that idiom about going, well, we have athletes all over the country who are, they're out past midnight, and that's when you get into trouble, right? And we always say nothing good happens when you're out past midnight. So I just thought that was a perfect and appropriate thought process. Under the 200 day, some traders get defensive. Above the 200 day, maybe they stay more risk on. So here's what I wanted to do. I just wanted to quickly build, I'm going to do a detach of this chart and slide this over here. And I'm just going to make it a 2-chart situation, change my time frame. I'll do a quick 5-day, 5-minute, and let's go ahead and maximize it for you all. And then I've, of course, got my personal study set details. So I've got some intra-period stuff. So I've got a 5-day. No, I don't want that. I want my 20 intraday. Let's see. Yeah, 5-day, 5-minute. There we go. And so that's got my 20-period exponential moving average in there. So there's the SPX. And then I'm going to put the, whoops, I'm going to have to separate these. So I'm going to unlink them. So they're both the broken chain. And then now I'm going to make this one the VIX. And so now you can putting these two side by side, you can obviously see the inverse correlation between them, right? And you can see what's going on right now as it relates to the VIX. On the right-hand side here is a broken downtrend line that got, this was an explosive VIX move, right? And then what did we do with the VIX? We got thrown back to the breakout level, and suddenly the VIX is rallying again. So, obviously that's intriguing from a trend analysis standpoint, and yet what's most important is the exact same thing as it relates to the S&P 500. Everyone, look over here. I'll draw that exact same line, maybe through like this. And check it out. What did we do? We rallied into the downtrend line that was support in theory, and then we broke it. So what did we do? We rally into it, and now we're in the midst of rolling over. The hope is that that doesn't hold below and that we don't make a new lower low. But now, unfortunately, as soon as if we take out these low candles here at 66.08, now the likelihood becomes much greater that we make a lower low intraday than we have fixed the trend. Okay, so can we take everything that we do, daily chart, weekly chart, apply it here? We absolutely can, right? we are still doing the same analysis, but we're doing it on a different window of time. Now, we have already seen, okay, so this is touchy. This is not great as we're in the midst of it, not ideal. Because now you're giving back after the quick bounce, giving back. And now the increased odds of continuing what we've undergone already are on the table. Doesn't mean I'm right in any way, right? This can change, and we could maybe get right back up above it, make a new short-term high, and maybe now thereafter it becomes a different story. But right now it is not ideal. So my hope was, more than anything, give you something for consideration. I mentioned this here in Trader Talk this morning, that a lot of traders will position these two side by side and utilize them as confirmation detail one way or the other. And an increase, let me just remind you of what we're getting from the VIX. What is the VIX telling us? It's an increase to the amount of put options on the S&P 500, and those traders who are aggressively protecting, institutional in most cases, aggressively protecting SPX positions, okay? So that's where we stand. Volatility is a little bit elevated, to say the least. Let's go ahead and take a look at the VIX on the daily. So we've had a pretty good swing here. Obviously, it was much higher, and we are, this is interesting to a lot of traders. But if you're that trader out there who's going to utilize an elevated VIX, a couple of things as it relates to doing so, obviously, is that one, we're going to get some bigger swings with an elevated VIX. Two, if you're trading options, many traders lean into elevated VIX windows not to speculate on long options, that is to say, not to buy calls or buy puts, but rather to sell contracts, because the increased volatility means juicier premiums traditionally versus what they would normally be, right? And that allows traders to see, as VIX then declines, then the value of premiums that they have sold reduce quickly, and they can then buy them back for lower pricing. And that's going to be, it happens much quicker with an elevated VIX than it would as the VIX retreats. That'll happen much more quickly. So that's why traders of options don't mind elevated VIX. Now, one other concept to bear in mind. If you wish to speculate, that's not a problem. Even with an elevated VIX, trader might choose to speculate, but that trader might also choose to incorporate spreads rather than simply speculative option strategies. Remember that a speculative strategy can be as simple as the long call or the long put, thinking the index or the security you're trading is going to go up in the time frame commensurate with your the strike price window of time, right? The expiration window, or go down in that window of time. But if you choose to make those spread orders where you are willing to cut your upside opportunity short, which is to say put a cap on your profit, okay, then you can often put yourself in a position, even with an elevated VIX, that's not going to be hindered by the value of the implied volatility, because you're buying one option and selling another. So one of those contracts is working with you and one's working against it, but it can be a way that a trader can, work to not be as tied to the volatility. So give some consideration to that as well. And of course, recognize that those are some classes we offer you here on the channel for discussion also. Okay, I see we do have a survey in the chat. Thank you, Rachel, for reposting that. So yes, of course, would love to hear from you. I know traditionally this is JB's class, and JB does an excellent job of working through a multitude of key points that he wants to educate on. And I know that that's not what we're doing here today. Nonetheless, would always appreciate hearing from you. And if you make any comments, those come to me directly. Of course, I'll happily read those, try to take your suggestions to subsequent classes as well. So please, if you have the time, if you have the interest, let me know your thoughts, and we'll go forward from there. Now, beyond that, let's talk about what's going on outside of the S&P, outside of the VIX. We can also take a look at one of our main leaders in the space has been the semiconductors, and they're making a similar move to what we're getting out of not just the S&P 500, but the NASDAQ 100 as well. So we know that the semiconductors have been our leader for quite the majority of our move to the upside here over the last few years, obviously tied to NVIDIA. And, at some point, we are going to see a bit of a deeper pullback. And it may be that we're just on the cusp of that right now as well. I mean, we've dabbled at this level a number of times. And I hope that that's the takeaway, is when we have a series of tests at a major important level, well, the more tests we have, the more important the level becomes. The more important the level is, well, the more significant a break through that level can be. Now, I should also point out that, as an example, one day below that level might not destroy everything, right? Sometimes a breakdown can be the impetus for bulls to come right back in and support, literally support the index. That's a possibility. But what we need to see is, do we maintain this level at all? So we're going to keep a close eye on the 6,500 approximate level on the SOX here. If we were to look for something akin to what we saw in the S&P 500 from a standpoint of potential support below us, let's take a look with the Fibonacci's and see if that can line up maybe with some former resistance areas. And it happens to. We could duplicate my line here and just add it down to this 38% approximation, and that can give us an area as well. So, maybe we just push this out to 2 months there. There you go. So, yeah, you can see that's basically the same thing as we saw in the S&P 500. Okay, so being prepared for it will help out a lot. All right. If you're prepared for it, chances are you might be in a more comfortable position as well. You might very well have reduced your position sizes. You might have been building cash to participate in such a move so that if it does get down there, you might want to be a buyer there. Those are the ways that traders are thinking about things, or at least those are a couple of key concepts here. Dom, I wish the color of my shirt would be the key. To be quite honest, I know there seems to be some consistency there with regard to JP's attire, but yeah, mine. You know what? Believe it or not, green just does not really fit into my overall color palette on the segments here. I lean pretty heavily into blue and some mauve and purple and that kind of stuff. I can't believe I said mauve. But yeah, those are the ones that hit me best. So green doesn't quite pop up in my palette, unfortunately. I wish it were that simple. My goodness, I would wear the greenest of green. I would go Kelly green for all of you. I would go Irish for all of you if I could. If that was the difference maker, believe me, I would do it for all of you. Okay, so that's where we are on the semiconductors. I want to talk about a space that I've been talking about a bit more in the last few months here, everybody, because we have seen a trend shift, and that is healthcare. So we're going to utilize the healthcare chart to talk a little bit more about not what's going on necessarily up here. I mean, yes, we talked this morning in Trader Talk, a bit of this volatility increasing and volume stepping into the move before we got the breakout in the sector. But the one here that I found most notable is going to be, of course, on that weekly chart, because I'm going to actually give you guys something here real fast. I get so many questions on this, so let me just give you a quick teaching moment before I move off of this chart. I'm going to go up into my drawings here and notice I've got a drawing set default. That just means everything that I've drawn on this chart appears on all my other charts, right? I'm going to save as a new drawing set. I'm going to call this daily. And then so these lines, everything on this chart can be held here. I'm going to go back. Let's add a second year. Let's make it 3 just for fun. All right. So now it's a 3-year the daily chart, right? And all of my lines are held. But as I go to my weekly and I want to clean it up, I can just eliminate everything and not have fear that I've done that on my daily. All my daily stuff saved, and on my weekly, I've got a clean chart now. Okay, so let's zoom in and redraw those lines. So the most important move here was this ugly sell-off where we took it all the way down. I mean, my goodness, this was a steep move in healthcare. So this is basically what I had drawn in. Whoops, let's go a little bit more like so. Basically what I had drawn in, right? Clear downtrend here. And we were, okay, in the midst of a downtrend, had some rallies into the trend line, maybe busting it out, but didn't get anything until we had this beautiful, huge, green, big candle right there. And that candle, not only, a couple of key things here. What happened on this candle? Most important, I think, was the break of the trend, right? The break of the downtrend. But, trying to get my draw tool in here. There it is. Okay, so a test at the 20-week, the low of the week at the 20-week moving average. Huge candle broke the white moving average. That's our 40-week moving average. Also broke the downtrend line here and broke the 100-week all in the same week. Okay, that is a very significant development, and it happened to be at the same time on the daily chart after we had consolidated and made a little bit of a short-term higher high. So we carry that into my daily, and here's that short-term period where things started to improve. So again, bringing you back to the reminder that we got to look at the weekly chart and then bring it into our time frame to fit our story and narrative and process. So on the daily, was this a call out? It absolutely was, for a couple of reasons. Oops, here we go. Remember this gap high? This gap high acted, oh my goodness, you're kidding me, acted as resistance. Okay, there's one test, fail. Another test, fail. Another test, fail. Getting the theme here, right? Another test, fail. Trend analysis reminds us that what is the current trend is more likely to continue than to break. Not more likely by 90%, everybody. I'm talking like 55% versus 45. Okay? That's what we're talking about. And then something changed. It happened right, I'm going to duplicate that oval once more for you. It happened right here. And we got above it, and then we kind of went sideways. Got thrown back to my same downtrending line. This was resistance. It became support. Jeff, I'm not going to argue with you. Yeah, if you want to utilize an oscillator like the MACD, go right ahead. But my point is much more basic and simple. You don't have to, right? You can. You absolutely can. But there are many users of technical analysis and many of our attendees here who benefit from just the basic support, resistance. What's the trend? Is the trend different? Has something changed? Etc., etc., etc. We don't have to be smarter than the average bear. We just need to be smart enough to make informed and hopefully well thought out trades, right? That's our goal. So if you utilize the MACD or the stochastics or your preferred oscillator of choice, by all means, keep doing it, especially if you're having success with it. But don't be misled and believe that you have to, right? Every oscillator out there is a measure of two things, price and volume, okay? We can keep it simple and look at price and volume and use that to our merit. So, longer term trend changed quite a bit. It changed on this maneuver right here, right there. Whoops, I should eliminate that because that's an oval and I wanted a line. But my point was, if you're watching Trader Talk, you've heard me have this conversation. We have been talking about this and the potential for the break and the hope that the break was coming and the setup of this ascending triangle. We didn't catch it in the moment, the incredibly nice increase to volume in here, but It led to a continuation breakout, which now is building a bull flag. And the fact is, we've carried out of a downtrend into an ascending triangle, followed it up with a bull flag, and we're testing the bottom of the cloth portion of the flag as we speak. Doesn't mean it's going to hold, doesn't mean it has to be immediately bullish. If it doesn't maintain, we might visit the 20-day, right? If we trade through that upper ledge at 1785, continuation move, okay? So I bring this one because the reminder that I think is helpful for many of us traders, the market doesn't move in our time frame, but the price action will still give you confirmation along the way. And if we don't get too antsy or anxious that the move needs to happen in our time frame, well, then we can just allow price action to dictate it for us, okay? Some of the time that means not being in full positions because you're uncertain and you just don't know. You want to be more confident and you just don't know. I don't blame you, and I will encourage you all to put yourselves in positions that are smaller in nature because you can deal with the machinations that the market will give you much more easily with fewer dollars devoted to our trades. I hope that you all find that to be helpful. That is a learning that I had to really lean heavily into personally. It helped me immensely. You know, I can't tell you that it's the only thing that I've done, the mind shift, so to speak, but getting to a point of complete and total comfort that allows you to manage, the price action and the movements that you might not expect. It's been a big help for me. So position size, very important. Okay, so we have talked a lot about the S&P 500 and the NASDAQ. We looked at the SOX and utilized healthcare here, but really we've talked trends, right? Longer term trends, intermediate term trends, short term trends. They're all essentially available for us as technicians. And the question that is most important to all of us is which time frame is the one you're trading. You might be watching that weekly and watching that daily, but trading on the hourly bars instead. That's cool too, right? But just recognize that your time frame and your determination of current trend is tied exclusively almost to that time frame. Right. And so when someone says, hey, what's the current trend? Well, we're looking at a daily chart. I think it's pretty clear to say the current trend in the healthcare here is to the upside. That's what we've seen. If we're looking at this on an intraday basis, that's going to be a little different. Right. So don't be misled and don't allow conversations that are happening in and around your sphere change your viewpoint. Okay. Make sure that if you're hearing from somebody else giving you a different viewpoint, ask them, what time frame are you looking at? What time frame are you trading? Hey, I was looking at it this way, and this was what I was paying attention to. What are you seeing? I mean, I don't know about you all, but I can have that conversation with anybody any day of the week, and I want to do that. That stuff interests me. It's a lot more fun than just simply assuming, we are all talking the same thing, and we all are doing the same thing. That is definitely not the case. Okay, we're going to wrap it there. Today was a little different for all of you, I'm sure. I hope the trend analysis conversation was helpful. I hope the position management, the idioms that I bring to the table are helpful as well. Big thanks to Rachel in the chat. Follow Rachel and me on X, Rachel-CS, Kevin Horner CS. And we've had that opportunity for a survey. Would love to hear from you there, everyone. So click that link and take the 60 seconds to put a score on there. Make a note or a comment if you'd like as well. Like I said, those come directly to us coaches, and we greatly appreciate your insights. They're really invaluable to us as coaches to continue our own improvements. So thanks for participating. Thanks for being here. Last thing, make sure to hit that thumbs up if you thought today was helpful. We want to get this out into the archive for y'all. So hope you all have a great rest of your Thursday. Market regardless, no matter what the day finishes like, tomorrow the sun will come up in most places, although it might be snowy here. But I look forward to seeing you all again soon. I will be back tomorrow morning with Connie Hill for our ETF Trader Talk, our Friday session. Remember, Friday is non-archived, so if you want to see Trader Talk at Market Open, you got to be there with us live. So have a great Thursday, everybody. See you again real soon.